Hey options traders, for today's option trading strategy, we're going to take a look at a reverse butterfly spread in Nvidia. The stock has been trading in a very tight trading range between 520 and 540 for the past 6 weeks. According to MarketSmith chart analysis, the stock has formed a flat base. And in situations like this, where there's a base setting up, there's typically a good chance that the stock will break out from this area at some point. Nvidia is a very highly rated stock with strong IBD ratings like a 98 composite rating, a 97 earnings per share rating, and more. So there's definitely a chance for a successful breakout here. But what happens if the breakout fails or if the stock breaks out to the downside? Well, luckily, there's an options trading strategy for that scenario, and it's known as a reverse butterfly. So this trade will benefit from a big move in either direction from Nvidia stock. And to execute a reverse butterfly spread, an investor would want to sell an in the money call, buy 2 at the money calls, and then sell 1 more out of the money call. So let's take a look at Nvidia stock and set up this trade together. So now we're on my Thinkorswim dashboard, and I'm going to show you how to set up this trade in your trading account. First, you're going to want to type in Nvidia in the box up here because that's the ticker symbol for the stock. And we're going to take a look at options contracts that expire the week of March 19th, 2021. And this little area right here is where you can select the type of spread you want to trade. So I'm going to select butterfly, even though this is a reverse butterfly. I'm going to select butterfly in this box right here. And then in the middle panel, you'll be able to see strike prices. And down here, I already have all of the strike prices, expirations set up for this trade. However, I am going to change this from buy to sell because this is a reverse butterfly spread, not a normal butterfly spread. And I'm going to be selling 505 call, then buying 2 525 calls, and finally selling 1 more 545 call. And that'll create the spread. And this trade is going to generate a total premium of $145, you can see right here. And the maximum risk for the trade is $1,855. What we're looking for with this trade is a quick price move, either higher or lower from this very narrow channel that Nvidia has been trading in for the past several weeks. So it's important to remember that a trade like this loses value every day through something called time decay. Long story short, time decay is simply a measure of the rate of decline in the value of an option over time. This trade will essentially lose value every day as long as the stock remains between the break-even points. To calculate the break-even points, you just want to take the lower strike of 505 and add the total premium you paid for the trade. Then you take the upper strike of 545 and subtract the total premium paid. And there you have it. So as for trade management, I'd consider closing out the trade if you lose 20% of the total max risk amount. So 20% of 1,855 is around $370. So once you're down that amount, it may be smart to cut your losses on this trade. So to recap, this option trade involves selling a March 19th 505 call, buying 2 March 19th 525 calls, and selling a March 19th 545 call. The premium received would be $145, and the maximum risk of the trade is $1,855. And there you have it. I hope this was a helpful trading strategy. Please remember that options are very risky and investors can lose 100% or more of their investment. So make sure that you practice in a paper trading account before you risk any real money, especially if this is new to you. And check out investors.com/futures-options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.